Hang on, is it 100% stocks risky? What if the stock market suffers a major correction?
The Dow dropped more than 500 points.
What if the stock market drops? What if the stock market crashes? What if the Great Recession happens again? What if there's another global pandemic? What about 2008? In this video, I want to talk about why I own 100% US stocks and why you should watch this video simply for entertainment value, because as with anything, I'm not a guru or a financial advisor. I'm simply a 30-something-year-old guy making his way through life.
Hey, Carter. Man, trying to expand my horizons, travel a little bit.
It's called personal finance for a reason, so let's dig into why I own 100% US stocks for now. Hey, my name's Cory. On this channel, we talk about personal finance and investing, and I'm on a mission to help people with financial literacy. And if you haven't subscribed yet, would you please consider subscribing so you don't miss an important video? Now let's jump in. Asset allocation is a fundamental part of investing. Asset allocation is just a fancy way of saying what investments should I own and in what proportions should I own them. What percentage of my portfolio should be in stocks, bonds, real estate, alternative investments, cryptocurrency, NFTs.
For the last 6 months, I've been working on my own NFT project that I believe is going to change the game. I really, really do believe it is going to be...
Should I invest internationally or should I only focus on the US stock market?
No idea.
Now, there is a mountain of research on this topic. But to save you the time and me the pain, I just want to cut right through the noise and let's get to the meat and potatoes of asset allocation and the case for 100% US stocks and how by owning 100% US stocks, you might actually be participating in the overall global economy. So you've probably heard a soundbite similar to something like this. Hold the percentage of stocks equivalent to 100 minus your age, and that'll give you your stock to bond ratio in your portfolio. So, for instance, if you're 30 years old, you should hold 30% in bonds and 70% in stocks. Boom, you're done. You have your perfect asset allocation based on your age. However, like most mainstream investment advice, this could not be further from the truth or accurate for you or me. Advice like this is targeted to the general population of people who subscribe to the mantra of work your entire life to save enough for retirement and retire someday when you're age 65. Now, the problem with mainstream advice to you and I is that it's harmful at best because we're not generalized or average. Advice like this pushes us into a generalized category that only takes into consideration your age. You have your own goals. You have your own dreams. Maybe you have kids. Maybe you don't have kids. Maybe you're married. Maybe you were married. Maybe you're married now and you don't want to be married. Maybe you were married and now you want to be married. We all have our own goals and dreams, aspirations. We all have our own risk tolerance. Maybe you want to travel the world. Maybe you found a career that just absolutely lights you up in the morning and you can't wait to get to your 9 to 5. Now, if you're anything like me, you probably started from zero. You started with nothing or very close to nothing and slowly began to realize the importance of how money works and how the compounding power of the stock market has the ability to generate hundreds or even millions of dollars if used correctly. When I finally decided to pull the thread of personal finance, it took me down a fascinating path. Now, to say I got bit by the personal finance bug would be a gross understatement. I began to read and absorb everything I could get my hands on, every podcast, every book, every article on personal finance I started devouring for about 2.5 years before I understood what this was all about. During these 2.5 years, I stumbled my way through building a money system. Now, when I started, I didn't even understand what an ETF was, guys. That's how far off track I was. ETF, exchange traded fund. And not only that, I wasn't even contributing 3% to my employer-based 403b retirement account plan in an aggressive stock fund that wasn't even matching the market. The aggressive mutual fund that I was investing in my 403b was not even matching the rate of return of the average S&P 500 index fund or a total stock market index fund. Insane. How do people not see the word aggressive stock fund and not look at the numbers and see that it's not even matching the market? Now, I was looking at investing all wrong. I was looking at putting money away into a retirement account as a loss rather than looking at it as a gain, a major gain. It's hard to say that I was wrong, but man, was I wrong. Man, did I miss out on some years of compounding. So that put a fire inside of me, and I was on a mission. I poured through my employer's 403b retirement plan before I found a zero-cost Fidelity index fund. So I quickly transferred all of my money out of this aggressive index fund into Fidelity's S&P 500 zero-cost index fund. Bye-bye, aggressive stock market fund index fund. I even went as far as to call Vanguard and get all of the necessary information and documentation for the CFO of my company to transfer our entire 403b to Vanguard. I literally did all of the legwork for the CFO of my company and put all of the necessary information on his desk with a Vanguard colored red bow attached to the top. Needless to say, it fell on deaf ears. At that point, I conceded to sticking with the lowest cost index fund in my 403b, the Fidelity's S&P 500 index fund. Then I decided to make an investment plan, a money system for the rest of my retirement accounts. After careful consideration and studying and reading, I landed on Vanguard's Total Stock Market Index Fund, VTSAX. Now, I've gotten a fair amount of questions on the reasoning behind this decision and how this came about. Why not hold some bonds in your portfolio to smooth the ride? Now, let's talk about bonds for just a second. Bonds are a stabilizing force in any portfolio. They help smooth the wild ride of the stock market up and down. But the flip side to that coin is that bonds are a major drag on a portfolio. It's a trade-off. People trade greater potential returns for the ability to sleep at night by holding some bonds in their portfolio. Bonds counter the volatility of the stock market, giving you a less bumpy ride. But again, this can reduce the overall returns of your portfolio. Now let this sink in for a minute. Hopefully you're looking at a 30 to 40 year long retirement at the age of 50 or 60, unless you retire earlier, which would be even more of a concern if you're not holding 100% stocks or an asset allocation that's close to 100% stocks. The concern about running out of money is a real one, or at least not being able to generate enough income to support your needs through the duration of your retirement. Now, I want to show you the possible differences in the terminal values of 100% stocks, 90% stocks, 80% stocks, and so on. Here it is. 100% stocks compared to 70% stocks for a 60-year retirement is 4 times more. Now stick with me here because this could get complicated. With an average rate of return heading into retirement with a portfolio of 70% in stocks leaves you with 1.8 million. 80% in stocks leaves you with 2.1 million. 90% in stocks leaves you with 2.4 million. And 100% in stocks leaves you with $2.8 million in a 30-year retirement. That's almost $3 million. Having a portfolio with 30% in bonds instead of 0% leaves you with 1/4 of the money after a long retirement. That's crazy. That's a lot of money to leave on the table just to avoid the stock market gyrations. Now, there are 2 things that help me maintain a 100% stock portfolio. The first thing is income flexibility. Most of us, once we achieve critical mass or are on our way, well on our way to achieving critical mass, will most likely have built or be in the process of building some form of passive or auxiliary income from somewhere. Whether this is rental income, a side project, or consulting, my income is completely flexible. If there's ever a large drop in the stock market or an adjustment that needs to be made, I can increase income from other sources or lower expenses accordingly as to not draw down on my portfolio. The second thing that helps me maintain a 100% stock portfolio is having a large emergency fund. Now, traditionally, a 3 to 6 month emergency fund is what people normally shoot for. However, if possible, I would recommend bumping that number up a little bit higher. Once you start approaching that crossover point, let's give those numbers a boost. I recommend 6 to 12 months or even 12 to 18 months of expenses saved up in a savings account that you can easily access. Now, what about international stocks? Let's talk about international exposure for a minute because I've gotten a lot of questions about this. International exposure. Obviously, the case I'm making is for 100% US stocks. However, owning VTSAX, or a total stock market index fund that includes all of the companies in the United States, also includes some international exposure. There's McDonald's all over the world. Toyota is all over the world. GE is also a global enterprise. So essentially, owning the Vanguard Total Stock Market Index Fund also includes some global GDP. I was surprised to see that the amount of companies that have a presence in other countries is almost half of the US total stock market. In J.L. Collins' book, The Simple Path to Wealth, Collins makes some great points about the additional risk that comes along with investing in international funds, as well as a higher expense ratio. Furthermore, the great US of A makes up about 15% of global GDP. The US is not a small player on the global economic stage. But yes, I'm well aware of home country bias, and I'm definitely not investing in the total stock market index fund because I think it's perfect or because I live here. You have to weigh the pros and cons, and you have to see for yourself if you're okay with owning the Vanguard Total Stock Market Index Fund and having a fair bit of international exposure built into the US's share of global GDP or the percentage of the US company's sales from other countries. If that ever decreases significantly on a global scale, I'll have to reassess my plan at that point. Simple is good, simple is easier, simple is more profitable. For you, J.L. Collins, The Simple Path to Wealth. Now, the best thing I love about this strategy is that 100% US stocks is simple. It gives me the time and the mental capacity to focus on other things, to focus on things that are important to me. Now, I totally realize that there are those of us who don't have the time or the energy or the desire to research portfolio theory or what to do with stocks and bonds and international exposure. So this is a strategy that I highly recommend if you have a long-term time horizon ahead of you. This strategy is the silver bullet for those of us who don't mind some corrections or drops or dips in the market, and we can purchase shares at a lower price. Hey, thanks so much for watching. I hope you got something out of this, and I hope this added value to you. If you haven't already, please consider liking and subscribing so you don't miss an important video, and we'll see you on the next one.